Good afternoon, everyone, and welcome to our webinar where we will talk about demand sensing on a tactical horizon. My name is Deborah Braquet. I'm Sales and Marketing Manager for Solventure LIFe, and our guest for today is our CEO, Professor Dr. Bram Desmet. All right, let's take first a look at the agenda for today. So we will first start off with a short introduction on Solventure. Who are we? What do we do? And then we will continue on talking about demand sensing. So first we will start with, okay, what do we understand with demand sensing? And then I will give the word to our CEO where he will expand on, how do you now sense demand on a tactical horizon? In the end, we will leave some time for some questions and answers. If you would already have some questions during the webinar, do not hesitate to already leave them in the question pane in your control panel, and then we will get back to them in the end. All right, so first starting with telling a little bit more about us. So Solventure, who are we and what do we do? So at Solventure, our goal is to turn your supply chain into a competitive edge. Now, how do we do that? Basically, we base ourselves on the framework created by our CEO, the so-called supply chain triangle of service, cost, and cash. What's the purpose of balancing that triangle? Of course, to maximize benefits. So we determine benefits in a metric called ROCE, the return on capital employed. And basically everything that we do with Solventure is in order to maximize those benefits. How do we approach that, or what's our strategy, let's say? Well, our strategy is to look at your strategy. So all the projects that we do, all the trainings that we give is in order to enable you to reach the goals that you have set forward. We have a mix of products and solutions that will help you reach those targets that you have set and reach in really driving the strategy that your company has put forward. Some of these products and solutions that we have is, for example, strategic benchmarking, where we will enable you to benchmark your financial KPIs with those of your competitors. Of course, we also help you in managing your sales and operations planning process with the Archiva software that we implement and that we help you with. Of course, you need a data connector to connect all the right data and have the right data in the right place and time. So we have our own data connector there to help you with that. And to really take your supply chain to the next level, we not only believe in advanced analytics, but also in training. So not only training on the concepts of the sales and operations planning process and on supply chain, but also training on change management. How do you really bring the vision that you have put forward as a company within the people that work in the company? And that can be like giving them training on understanding the sales and operations process and the different elements there, but also helping them to adopt new technologies and to adopt new ways of working. So really helping you guiding that change process. Now, I was talking about analytics that can help you take your supply chain to the next level. One of that is what we're going to talk about today, Solventure LIFe, leading indicator forecasting. Another one is Solventure multi-echelon inventory management, where we really take inventory management to the next level. Anything that we do is a holistic approach, so we will never look at tooling alone or analytics alone, but really at the people, the process, analytics and tools as a whole concept. All right, so I'm gonna dig in a little bit further on Solventure LIFe, because that will be the main topic of today, and which is connected to demand sensing as well. So Solventure LIFe, where should you see that, or how should you see that as a product or service? Basically, we invest a lot of time and money into getting a better sales and operations process, and how can we drive a better s&op process. Now, a lot of the people in our company work with companies on forecasting, and we've seen that people today forecast typically with only internal data, or as a main factor looking at historical data to predict the future. Now, we were asking ourselves, like, the world is changing around us all the time. How can we bring external information into account, and can us help that improve forecast accuracy and gain better insights? Well, the answer is yes. We have had PhD researchers in our team who have been digging into this topic, and we've seen that by including external information, we can really bring more sense to the companies that use this, and really bring more insights into what is driving the demand and what is really happening in that marketing environment. So what we've done is we've built a tool where we connect with global data coming from different data sources. As you can see here, for example, we connect with data in the US, in Europe, in China, in South America. So really global data. I think up to now we have more than 10 million global indicators in our data cloud, which we match with your sales. And basically, how does it work? Well, we bring the external data in, you bring your internal data in. In the cloud-based tool, you can use the algorithms to make leading indicator forecasting models. So basically, the algorithm will automatically select which indicators are relevant for you as a company, and then you can start improving your supply chain. Now, our customers, some of our customers are presented here. As you can see, they are spread across different types of industries. And an important note there is also to say that not all industries are affected by the same types of external information. For example, if you look at food and CPG types of companies, they are more affected by effects like calendar effects or events, promotions, whilst when you go more further from the customer, basically, and more in those second tier, third tier suppliers, for example, in chemical or automotive, we really see that economic variables play a huge role in helping you forecast your demand, as well as weather. So really bringing and taking those external effects into account is what we aim to do, and what we aim to bring you insights on those levels. All right, so that's about us. Let's get into the topic of demand sensing, and later on into demand sensing on the tactical horizon. So I'm first going to give you a little bit a notion of what we understand in demand sensing, and then I will give the word to Bram, which will dig in further on demand sensing, really on that tactical horizon. So why should you even forecast, right? Forecasting, why is it so important? Well, it helps you better manage your whole supply chain, and helps you answer questions like, how much inventory should I carry? Can I maintain my service levels? Should I invest in new production plants? What materials do I need to source? How will I reach my sales targets? How will I organize my sales teams? So you can already imagine there are so many questions that you need to answer, and by having a better estimate of your demand, you will be able to answer those questions a lot better. So demand sensing, what should you understand about demand sensing? Basically, demand sensing will try to optimize the short-term forecasting by using real-time information. So they will look at, for example, point of sales data, data that's coming from the supply chain, shipping data, order data, and will really take that into account in your short-term forecasting practices. That should lead to a better forecast accuracy. And how does it really work? Well, it will look at your sales data, and the machine learning techniques will detect patterns that will match with the real-time data, and that of course match with your sales, and that will help enable you really to automate that process and bring you a more accurate forecast accuracy on that short-term horizon. Now, so results are a better forecast on a short-term horizon. It will use real-time information, so you will have that look on what's happening in your environment at a shorter term. So we're talking about 1 to 3 months out. This happens on an SKU level. That's an important fact. And of course, it results in less inventory, reduced operational inefficiency, and so on. So the benefits that we were talking about earlier, these are all better taken into account when you have a better forecast on that short-term horizon. Now, of course, what happens after that short term? And we see that a lot of companies face difficulties in really getting a good demand forecast on the longer term horizon because, of course, it's more uncertain, let's say, what is going to happen in 4, 5, 6 months. And the short-term real-time data that you have from the demand sensing doesn't really work on the long term because you don't have that information, basically. So you will need to look at other things. And that's where you really need to go from demand sensing on that short-term horizon to a tactical horizon. Now, what are the challenges there? As I said, it's not so easy to predict what will happen on the longer term horizon. Hypes and trends are typically also short term, so it doesn't really make sense to take them into account on a really long term. And also, how do you look at, or which data should you take into account when you look on a longer term horizon? And one of the main things that we see there is that we should shift from that SKU level of information to a more aggregated level of information, because you do not want to forecast an SKU item for 6 months out. That will bring you very nervous pattern, and it will not really help you to answer these questions that we've asked ourselves in the beginning, really strategic questions like, should I open a new production plant, or should I have more people in my sales teams in specific regions? That's not really going to help there. So you really need to take it to a next step and need to kind of elaborate to a higher level of product information. So typically that would be a product group in a specific region. And there we see that if you go to a more higher level of aggregation, you need to start looking at those macroeconomic influences. Because if you look at a higher aggregated level, you should also look at, okay, for that product group, what are the effects that are coming into place? And when you have determined those, Bram will tell you all about it, how to do that. But when you have determined those, that will also act as a really crucial impact to make those strategic decisions. So if we would look at it from a kind of triangle, but then operational, tactical, and strategical forecasting, then you would kind of map operational planning with demand sensing, so really the forecast on the short term, but then you should take it to that tactical horizon, start sensing your demand on a longer term horizon, do that in monthly buckets in on a 6 to 12 months horizon, where you take into more economic data into account or weather data, and that will really help as an input to make the longer term decisions. And honestly, the decisions to open a new production plant, that's not something which you're gonna make in 1 or 2 months. It should be a well balanced decision where you need to have information on a longer term horizon. So that's where really the value comes into place from demand sensing on that longer horizon. Okay, so I hope you understand what we mean with demand sensing on a short-term horizon, where we want to get to at a tactical horizon. And I think now I will give the word to Bram, who will further elaborate on how to really do that.
Thank you, Deborah. Let me indeed explain. So our methodology for leading indicator forecasting. Basically what is different about leading indicator forecasting versus traditional forecasting. This is what is captured in this graph. What you see here is that traditional forecasting methods are extrapolation methods. So if you have inflection points in your sales, and the dashed line here shows a first inflection point, where before the inflection point you see an increasing trend, traditional extrapolation methods will just extrapolate that trend towards the future. Of course, if all of a sudden the sales starts declining, traditional forecasting methods will go wrong or will predict that wrongly. And the goal with leading indicators is to be better able to predict downturns and upturns, because likewise, if you look at the second dashed line, let's assume that you are recovering from an economic crisis. Well, certainly over the last few months, your sales will have been declining. If you use traditional forecasting methods, they will simply extrapolate that decline towards the future. But at the same time, you know that will be wrong, because sooner or later, you will have an upturn again. And the question is, can we find macroeconomic indicators that are sufficiently leading to help us with better predicting the upturn in that specific case? And of course, we try to look for, in this case, macroeconomic indicators that are leading. And the bigger the lead, the better. So in this specific case, I might be looking at an indicator, that's the dashed line here, where I say, if this indicator has an upward peak, that corresponds with an upward peak in my sales, maybe 3 months or 6 months or 9 months later. That's what I'm looking for. Or likewise, if I would be a bit later in that time series, I see that this indicator, instead of declining, starts increasing again, and I want to use this indicator to predict that 3, 6, or 9 months later, my sales will flatten out and will then I will see an upturn in my sales again. That's basically what we want to do with leading indicators. Instead of spending too much time on theory, let's look at a case study, an exercise we did recently with a global producer of steel. And what's kind of the situation? It's a second-tier supplier, which means lead times are a bit longer. They were looking to improve their input for their strategic and their financial forecasting. And they were also looking for a means to validate their current marketing or market intelligence. And how do we start when we have a specific case? It's shown in this graph. So what we see in black is the actual sales. And if you would only see the black line, it seems like a very highly variable pattern. Yeah? And still, we don't do this at a customer SKU level. We typically do this at a higher level of aggregation. So we might look at a product group in a certain country or in a certain region, but still we can see significant variability. If we want to reveal the underlying macroeconomic trends, the first step is really to take off the variability. And what is the variability explained by? Well, it could be calendar seasonality. It could also be events. And what could be events? It could be a price increase or decrease. It could be a change in import tariffs. And we all know that Mr. Trump in the US has been declaring import tariffs. So this really gives a major shock to your sales pattern. You need to model all of these events. Weather can also be of influence, not in this specific case, but if you are delivering to the construction industry in the US, your sales might be heavily influenced by tornado seasons. Or if you're in a soft drinks business, yeah, for sure, if weather is hotter or weather is cooler, that might again influence your sales and your sales peaks. So before we can actually start matching with macroeconomic indicators, the first important step is modeling the peaks and removing the peaks, in fact, by modeling all of that peaks. If we do that, we can reveal the underlying cycle, which in this graph is the red line. That's kind of the smoothed sales curve here. And once we have the red line, we will start looking for which macroeconomic factors are now in fact explaining the red curve, and preferably explaining whether the red curve will go up or go down 3, 6, 9 months in advance. That's what we want to do. How is our, or what is our typical approach? Well, we have different aspects. It's explained here in this slide to the right. We do a brute force analysis, and I will explain how that works. We typically also do a mind mapping exercise to kind of get people's expectations out of their heads into keywords, and based on those keywords, we can search the database for indicators which potentially are intuitive or expected. But the interesting aspect in this case is that by doing the brute force analysis or the brute force statistics, we were certainly possible to challenge a bit the current thinking of people in marketing and in finance, and I will explain step by step. What is the brute force analysis? Well, basically we run a sales pattern against our database of today more than 10 million indicators, and it's like finding a needle in a haystack, finding the relevant indicators. If you have 3 years of history, or in the best case 5 years of historical sales, you need powerful and advanced statistical techniques to be able to do that. That's certainly where we have been spending most of our research time on the last 6 to 7 years, and for which we have developed powerful statistical models. And for this specific steel producer, if we looked at which type of indicators popped up, the result is shown at the bottom. We had quite some indicators related to exchange rates, indicators related to raw material of the producing products, and indicators related to key supplying industries. If we compare that to the mind mapping exercise, so that's another exercise we typically do. We try to gather salespeople, marketing people, supply chain people, purchasing people, financial people around the table. It can also be a virtual table. We can easily do that online. And we do a brainstorming exercise where we say, okay, what do we expect if we look at this product group in the US or in Europe or in Asia or in a specific region? What do we expect are drivers for this product group in that specific geographical area? And then people come up with ideas, and we try to cluster that in keywords. So anything related to steel, anything related to mining, carbon, oil, iron, automobile, construction, ship boats, infrastructure. So you will see back some of your application markets. You will see back some of your key raw materials. You might see complementary products. So maybe if next to steel, customers can also use, I don't know, plastic or fiber-based products. Well, depending on how those competitive products are going, that might also influence my products. So you really try to define a little bit what is the ecosystem in which I am operating. What was very dominant in the discussion with this customer was oil. They really expected that oil production, oil price, these type of indicators were going to be dominant in, let us say, explaining the behavior of this specific product group. And so it's also coming back here in that mind map or in that list of keywords. Based on these keywords, out of the 2 million indicators, or out of the 10 million, indicators we have today, we can make subsets of indicators, and basically these are subsets where we more or less expect a relationship. Whereas the brute force, which was on the previous slide, this is bluntly using statistics to find out where there seems to be a proven relationship. Whether that relationship is then intuitive or not, in any case, there seems to be a relationship. And contrasting the two actually leads to new insights. That's what we want to do. So coming back here to oil and oil price, well, does oil price predict the upturns and downturns in this specific case? Well, on the one hand, there is some good news, because if we look here, let's say the second half of the time series, we see that there is a sharp decline in our sales. And at first sight, yes, the oil price could explain a drop in our sales, and it also seems to have a certain lag, in the sense that I see that the oil price is dropping first and my sales is dropping like a couple of months later. So on the one hand, that's good news, because yes, there might be a relationship between the oil price and my sales. On the other hand, if I look at the first half of the time series, well, in my sales, I clearly see an upward trend, a kind of a peak, then a downward trend and a downward peak, before reaching an upward trend and upward peak again. And that first half of the time series is not really well modeled by the oil price, because there seems to be some volatility on the oil price, but if you look at the level of the oil price, it's relatively constant. So yes, on the one hand, it's good, but primarily for the second half of the time series, and it doesn't really match the first half of the time series. If we would use this indicator to make a forecast, well, basically we would need to use a 4-month lag. So the time lag here between the green and the red smoothed sales is 4 months. And if I would use that to make a forecast model, well, again here, it seems to provide a very good fit with the second half of the time series, but it's not providing a really good fit with the first half of the time series. And that's, I believe, a major pitfall for many companies, that if you start looking for indicators, you basically look for what you expect. And there is a judgmental bias. Maybe there was a strong relationship with oil price, I don't know, 15 or 20 years ago, but we all know that since in the US people have started fracking, something in the oil price has changed. It seems that the dependency on oil at least has been a bit more relaxed for, I don't know, 5, 10, 15, 20 years. So historical ties with the oil price might be broken since we started fracking oil in the US. And that's a big danger. If you only look for what you expect, basically you might not find what is really driving your sales today. Coming back to the brute force analysis, which a bit at first hand to their surprise, but then going forward seemed to be more intuitive and logical. There were quite some indicators related to exchange rates. And if we make a comparable model using the US versus the Euro exchange rate, well, the result is actually shown on this slide. So again, if we look at the second half of the time series, well, the green curve, which is my exchange rate of the euro against the US dollar, I see that again, the steep drop in my sales in the second half of the time series seems to be pretty well explained by that exchange rate. And also, if I look at the first half of my time series, well, I see my sales going up, then going down, and going up again. That pattern is more easily recognized in that exchange rate. And also, if we look then to the right, just making a forecast model with only the exchange rate reveals that indeed the upward peak and the downward peak, upward peak, and then a strong decline seems to be explained, in fact, much better by the exchange rate compared to the oil price. And this is just one example of how using powerful statistics to kind of stretch your mind and create new insights in what are potential drivers, can lead to a better result. And we really believe in the two. We don't believe in a black box model which has 50 indicators which nobody really understands. It is important that you do understand what are the drivers, and that you are able to explain the drivers to salespeople, to marketing people, to financial people, to the investors community. But using powerful statistics for sure will expand and deepen your insights. That's what this case is basically proving. And yeah, this is just showing the result again. So if I would only use the oil price, I have the match on the left. If I use the exchange rate, I have the match to the right. What is not shown on this graph, but if you would then base your forecast on the oil price, you would actually see that you get to a quite different result versus basing your forecast on the exchange rate. And both indicators had a 4-month lag or a 4-month lead. So both indicators allow you to forecast basically over the next 3 to 4 months. The forecast is shown here in this graph, and this is a forecast not only based on the exchange rate, but it's also including indicators related to some raw material related indexes, and it's also including some indicators which are related to some of the industries to which you are supplying. And if you include somewhat more indicators, again, we are not fans of building models with 50 indicators, because they become black boxes and they will be used as long as they perfectly predict the future. But a model remains a model, so if the model has not been fed with certain information, sooner or long it will have not seen a certain event happening. And if people don't understand why the model was wrong, they will simply no longer use it. So we are more fans of maybe using 3, 4, 5 indicators, which we do understand. And if then something was not predicted well, it's much more easy to understand why it was not explained, because most probably the information was not in the model. That also means that in a forecasting process, you need to keep on looking for an interaction between a model and a business user who needs to interpret and adjust if he thinks he has knowledge which has not been put in the model. And based on that model, yeah, on the one hand, you see that the historical fit becomes a bit more smoothed, so we get a bit closer to the red line. And also looking forward, you can see here a kind of a trend forecast. So this is the trend forecast. This is not yet including any calendar seasonality. Once you have the trend forecast, you do need to put back on the seasonal effects. And what do we know with unknown information like weather information? I cannot predict what the weather will be 3 to 4 months out, or I cannot predict whether there will be a new import tariff being announced, yes or no. Well, for information which is not known, you can basically run scenarios. So if I look towards the future, well, I can simulate like, okay, once I have defined historically what is the weather dependency, towards the future I can simulate like, what would my sales be like if it's a very cold and wet winter? Or what would my sales look like if it's a very cold and dry winter? And what would my sales look like if it's very mild and wet winter, or mild and dry winter? So once I know what is driving, what are my sales drivers, even if I don't know what the weather will be like in November, December, I can still run scenarios to see like what's the sensitivity of my sales to some of those inputs. So that's how we make the forecast. And does it help leading indicator forecasting? Well, the answer is yes. And what we typically do to prove that is we take a certain reference period. So for this specific case, we said, okay, let's take out 2016 December till 2017 April from the data. We try to forecast that time period using different methods, and then we will basically just look whether the leading indicator forecast has led to a better result. And well, in this case, we do see that working with leading indicators with the live forecast shown here on the left column, where the error is on average 7.85, we kind of halve the error of more traditional forecasts. And the traditional method which has been applied here is the Holt-Winters method. And yeah, how does the traditional method work? Once more, it extrapolates the recent trend. And the question is, yeah, what is the recent trend? Well, if I look at this time series here, typically that's a parameter you need to master when you tune your forecasting model. And on the one hand, I could really aim for the long-term trend. Well, if I would use the long-term trend, the long-term trend seems to be continuously decreasing. So then I would most simply predict a decrease of the sales. If I would use the recent trend, if I kind of look at the last 9 months, so to speak, there seems to be a slightly increasing trend. So depending on the parameter setting of my forecast model, I will focus on the long-term trend, which will be decreasing, or I will put more focus on the recent trend, which would be slightly increasing. But yeah, irrespective of the parameter I would use here, I would always be wrong, because I seem to be really in a kind of a rebound driven by changes in the exchange rate. And that's what the live forecast, the leading indicator forecast, captures in a much more intelligent way compared to more traditional forecasting methods. And well, this is basically a comparable modeling. So if I would not include the exchange rate, I would get to an accuracy of around, or an error of around 11%. If I do include that exchange rate, I further decrease my forecast error, and in the end, I kind of halve the forecast error compared to more traditional methods. And yeah, we're open for questions now, so feel free to put some questions in the question box. But maybe just to close off, my expectation is really that as more and more data becomes available, as more powerful analytical methods become available, as computing power becomes more and more easily accessible, the future of forecasting will really more be in this type of causal models, where we say, okay, I start from my demand drivers, I model my demand drivers, and instead of just extrapolating the recent trend or seasonality, I try to look where my drivers will be going and use that as a basis to forecast the future. And a big advantage is that it triggers an enormous interest, so to speak, not only from a supply chain or an analytics community, but as well from a sales community and from a financial community, because better understanding what is driving my sales, well, that's interesting for sales. So instead of sales no longer cooperating in the forecasting process, well, they get something back. They know what is really driving their sales, and a understanding will also help them in better executing their sales job. It certainly triggers the interest of marketing people, which basically are investigating market drivers, but so far have done that not necessarily in a quantitative way. And also for the financial community, being able to explain to the investors community what is driving your sales and why your sales is going up and is going down, it improves what in financial circles is called the equity story. You basically can pitch your company in a better way to investors. It creates more trust. So leading indicators not only leads to a better result, it certainly also has a much broader audience within your company, and makes that people have a more common and shared interest in the forecasting process, which certainly has not been the case in the more traditional forecasting processes and approaches. So I will pause here, Deborah, and I'm happy to take questions.
Okay, Bram, thank you for elaborating on that. I'll start with a first question. How do you remove the variability from the time series? Example, given events, do you need some internal data for that?
Yes, let me quickly go back to that slide where we show that. And this is basically where it starts. There's two ways to remove, let us say, variability. On the one hand, there is methods available like filtering methods, which kind of automatically filter out peaks. There is also methods available which would kind of indicate like, hey, this is a strange peak. What would this be? Has this been a promo? Has this been a price change? So we can also use methods to indicate potential events. But I believe the best way to take off events is indeed to really specify events like, and it's a gradual process. So if some of your product ends up in consumer markets, you may have calendar effects and not only monthly calendar seasonality, but you might have an impact of holidays, like when do we have holidays, when do we have public holidays that might influence shopping behavior of consumers and indirectly affect your sales. So we are basically trying to look for what are potential effects that would be affecting your sales, modeling these in, see whether the effects are significant, and it's a kind of a gradual modeling process that we would do to make sure that what is being shown as a result is really a good basis to start matching or modeling macroeconomic factors.
Okay, thank you. Another question, does this type of forecasting also work well in a business with few customers where the change in demand can be heavily influenced by the decision of one customer? So said differently, is there a minimum number of customers for the trend to follow industry or economic indicators?
Good question. Yeah, I have two answers here. A first answer is like, if the ordering pattern of an individual customer is really visible in your time series, then you should not try to statistically model it. If your sales is primarily depending on one or two or three customers, you need to start collaborating with those customers, do collaborative forecasting, and instead of trying to predict what this customer is going to buy from you, most probably you want to predict either his sell-through to his customers or his consumption. So really digging into a collaboration and better predicting together when he will order based on his consumption and his inventories or on his sellout. When the impact of an individual customer is visible, collaboration is really the single good or right answer. At the same time, as I told earlier, that's the second answer. We don't typically do this on a detailed level. So you don't look for macroeconomic factors on a customer level or on a customer product level. You try to do it on an aggregated level. So you will look at a certain product group. You will look at the combination of that product group in a certain region. And if you look at the aggregated level, typically the influence of individual customers and individual customer orders is a bit reduced. So the effect of individual customers would be less on the aggregated level, but if it would still be visible, yeah, then the only answer is don't model it statistically, but go for customer collaboration.
Okay, thank you. Then another question, what's your experience with companies adopting this type of technology? How do they experience this?
Can you repeat the question, please?
So what's your experience with companies adopting this type of technology? How do they experience this?
How do they experience this? I think as with any new technology, in the beginning, there might be some resistance because in general, people are quite averse towards new technologies or algorithms. So they kind of need to, they need to get to know how to use this type of technologies or techniques. But at the same time, once they are through the initial process, they typically cannot imagine how they would live without it, and they would never want to revert to the old situation. So certainly, for instance, to give an example, many marketing people are buying a lot of research reports from external companies. They get lots of PowerPoints and Excel files, which are very unstructured, and they have no means whatsoever to couple all of that market input to what is now really driving the demand and how will that impact our mid to long-term forecast. And once they have seen and have been using this type of more quantitative tools and techniques to do more quantitative modeling, where they can really test which information makes a difference and is worth buying, and which information does not seem to have any relationship or impact on the sales, so it's just a waste of money, well, then they will never revert back to the old situation. So once people get it adopted, they can't often imagine how to live without it. It's a bit broad or general question, but that's kind of the change process you need to go through when you bring this type of new technologies into your company.
All right. Okay, thank you for answering the questions. Thank you for the people who have posed the questions as well, and for your interest. I think we can finish up here, as time is money. And maybe I want to close off with, first of all, thanking you, Bram, for giving further detailed information on leading indicator forecasting and demand sensing on that tactical horizon. On another note as well, if you're as a listener interested in trying it yourself, we are hosting some free trials, so you'll be able to try it out for yourself with your own customer data or your own data, or use one of the demo data that's in the tool available, and see what it can mean for you. So you can go to our website, and there you can sign up for a free trial. And then I would like to invite you for our next webinar, which will be in the beginning of December. And also we will be visiting the IBF event in Amsterdam from the 14th until the 16th of November. So we would be happy to meet you there as well. Thank you for listening and for dialing in, and hope to see you next time. We will send out the presentation after the webinar, so you can revert back to what has been said here today. Thank you.
Thank you. Bye-bye.
Bye-bye.